In early 2026, tensions between Iran and Israel escalated into one of the most serious geopolitical confrontations in recent years. While the conflict is unfolding thousands of kilometers away, its economic effects are already being felt across the world. In South Africa, one of the first signs of that impact is appearing at the fuel pump. Petrol prices have already started rising. For millions of South Africans who rely on fuel for transport, commuting, and business operations, this increase represents more than just a temporary inconvenience. It reflects a much larger economic chain reaction that connects global conflicts to everyday life. To understand why fuel prices are already rising, we need to examine the global economic system that links geopolitical conflict to everyday economic activity. At the center of that system is one commodity that has shaped the modern world more than almost any other: oil. Oil is often described as the lifeblood of the modern global economy. It powers transportation, networks, it fuels industrial production, and it enables international trade. Every day, millions of barrels of crude oil move across oceans to supply refineries around the world. Many of the largest oil producers are located in the Middle East. Several of these countries are members of the powerful energy alliance known as the Organization of the Petroleum Exporting Countries. By coordinating production levels, these nations play a major role in shaping global energy supply. But the production of oil is only one part of the equation. The transportation of oil is equally critical. A significant portion of the world's oil supply must travel through a narrow shipping route located between Iran and Oman. Despite being relatively small, it carries an enormous share of the world's oil exports. This route is known as the Strait of Hormuz. Roughly 1/5 of global oil shipments pass through this single passage every day. This means any military tension involving Iran immediately raises concerns about potential disruptions to global oil supply. Oil markets react extremely quickly to geopolitical risks. When conflicts emerge near major oil-producing regions or critical shipping routes, traders begin anticipating possible supply disruptions. Even if oil supply has not yet been reduced, the fear that it might be disrupted can be enough to push prices higher. Oil markets operate largely on expectations. If traders believe that future supply could become constrained, they begin buying oil contracts immediately. This sudden increase in demand pushes global oil prices upward. One of the most widely used benchmarks for global oil prices is Brent crude. When geopolitical tensions rise in the Middle East, Brent crude prices often climb rapidly. This has happened repeatedly throughout modern economic history. During the 1973 oil crisis, oil prices surged after several major producers restricted exports. A similar pattern occurred during the Gulf War. In both cases, energy markets reacted strongly to geopolitical instability. These events demonstrate how closely energy markets are tied to global political events. For South Africa, rising global oil prices translate quickly into higher local fuel prices. Unlike major oil producers, South Africa depends heavily on international energy markets. This is because the country imports much of its crude oil. When global oil prices increase, local petrol and diesel prices eventually follow. Fuel is a crucial input for nearly every sector of the economy. Transport companies rely on diesel-powered trucks to move goods across the country. Public transportation systems depend on fuel to move millions of commuters every day. Farmers rely on fuel-powered machinery for planting, harvesting, and irrigation. Because of this, rising fuel costs ripple throughout the entire economy as transport becomes more expensive. The cost of delivering goods increases. Retailers often pass those costs on to consumers. Over time, everyday products become more expensive. When fuel prices rise, inflation often follows. Inflation refers to a general increase in the prices of goods and services across an economy. Energy prices are one of the most important drivers of inflation worldwide. Higher fuel costs affect production, transportation, and distribution. Businesses facing higher operating costs often raise prices to maintain profitability. In South Africa, inflation is closely monitored by the South African Reserve Bank. The central bank's primary goal is to maintain price stability. If inflation rises too quickly, policymakers may increase interest rates to slow spending and reduce price pressures. However, higher interest rates also slow economic growth. This creates a difficult balancing act for policymakers. Another way global conflicts affect South Africa is through currency markets. During periods of geopolitical uncertainty, investors often move their money towards safer assets. This process is known as a flight to safety. In many cases, investors shift capital into currencies like the US dollar. When this happens, emerging market currencies such as the South African rand may weaken. A weaker rand makes imported goods more expensive. Since South Africa imports oil, a weaker currency can increase fuel prices even further. This creates a double economic pressure. Global oil prices may be rising at the same time that the local currency is losing value. Together, these forces can push petrol prices significantly higher. The larger question facing economists is whether this conflict could trigger a broader global energy shock. Over the past several years, many countries have struggled to control rising inflation. Central banks raised interest rates in an attempt to stabilize prices. In many cases, inflation had begun to slow. However, rising energy prices could reverse that progress. Since South Africa imports oil, a weaker currency can increase fuel prices even further. This creates a double economic pressure. Global oil prices may be rising at the same time that the local currency is losing value. Together, these forces can push petrol prices significantly higher. The larger question facing economists is whether this conflict could trigger a broader global energy shock. Over the past several years, many countries have struggled to control rising inflation. Central banks raised interest rates in an attempt to stabilize prices. In many cases, inflation had begun to slow. However, rising energy prices could reverse that progress. For developing economies like South Africa, this presents a serious challenge. Higher interest rates can slow investment and economic growth, but high inflation reduces household purchasing power. Managing these competing pressures is one of the most complex challenges facing economic policymakers today. The conflict between Iran and Israel highlights just how interconnected the modern global economy has become. Energy markets link distant regions together. Financial systems transmit shocks across borders, and supply chains connect producers and consumers across continents. In South Africa, the economic effects of this conflict are already beginning to appear. Petrol prices are rising, transport costs are increasing, and inflation pressures may soon follow. Whether these economic impacts remain limited or become more severe will depend largely on how the conflict evolves. But one thing is already clear. In a globalized world, even distant wars can quickly affect the cost of everyday life.